Hello, my name is Shrans and this is a series on developing your equity research process. In this video, we are going to talk about the second category of ratios, which are the solvency ratios. So let's get started. Now, when we talk about solvency, what it really means is the financial health of the company's ability to operate on a longer time scale, to pay all of its debts and to pay off all of its liabilities, right? So, if you think about it, or as you would already know, that there are two sources of capital, right? One is equity, right, which the owners invest into the business, right? And the other is debt or external capital, right? And that is a liability which the business has to pay, right? And mostly this sort of trade-off between debt and equity is what we're trying to capture with solvency ratios. So we're trying to understand if the company is financially sound enough to service and pay back any sort of borrowings that it might have, right? So now there are several solvency ratios and there are several versions in which you can calculate, or there are several ways to basically think about this trade-off between debt and equity. Now the first one is the most commonly used one is to look at debt as part of capital or debt as equity, debt versus equity, or you could also take a look at debt versus assets. So this is mostly it is debt to capital or debt to equity. So we're just trying to understand that what is the ratio of these two sources in the capital of the company. The second one that you could look at are all the non-current liabilities to equity and assets, and this would be slightly higher than the previous ratio, right? And this just gives you an additional perspective about the long-term liabilities of the company versus the net worth of the company or the total assets of the company. Then there is also liabilities to equity or assets. So obviously you might know that assets equal liabilities plus equity, right? So here we're just basically looking at total assets, total liabilities, and trying to see that what percentage of total liabilities are, what percentage of assets are being funded basically by liabilities, whether current or non-current, right? So these two, the later two ones, the non-current liabilities to equity or the liabilities to equity, are not very, very much used, so to speak, or very commonly used, so to speak, but still they might provide some bit of additional insight about the structuring of liabilities in non-current and current as well. Then we have interest of fixed charge coverage, right? So mostly interest coverage would be mostly in case of all the companies. Fixed charge coverage is useful for companies that also have lease liabilities. So interest coverage is calculated as the profit before interest and tax divided by the interest that the company has to pay, or the annual interest payments. And fixed charge is basically calculated as the profit before interest, tax, and lease payments, right, divided by the interest and also the lease payments for that particular year, right? So because that sort of profit is from where the company is servicing its lease liabilities and its borrowings as well. So we can get an idea of how much profit does a company generate in 1 year, and how many years worth of interest or can it service with that 1 year of profit. Basically, this is what it is. This is calculated in times, x times, right? So a lot of time you might also find that a company has no borrowing, but it suddenly takes borrowings, and then its interest cover drops down from, let's say, hundreds and thousands to just, let's say, 40 or 50, right? So although this is a very drastic drop, but still a 40 or 50 times interest cover is more than sufficient, right? Then we have debt to cash and cash equivalents. Now, again, this is not something that is very commonly used, but you could just look at the complete debt of the company and versus the cash and the cash equivalents, and you can understand that in case of any sort of severe financial distress or problems within the company, or any sort of default on its debt, or any sort of breach of its covenants where debt might become immediately repayable, then you can understand that, okay, if the situations are really bad, then how much cash does the company have in order to cover its liabilities? Although if the situation is very poor, then it is very, very rare that the company has enough cash or enough assets basically to pay off the liabilities, right? So now you think about this fact that a lot of investors actually prefer companies that have very low debt or are virtually debt free, right? And this is a valid point as well, because whenever there is debt, there are costs of financial distress, which is basically the whole capital, which is one of the theories of related to capital as well, right? Because debt is cheaper than equity, right? Because it has preference in payment over equity, right? But obviously, when there is debt, you have a fixed commitment. With equity capital, there is no fixed commitment, right? Dividends are not fixed, but interest payments are fixed, right? So if a company reasonably uses debt, then it can really help for its growth, right? And if it is able to generate enough return on capital, so it might not be such a bad thing after all, right? So that is basically the things that we had to explore with respect to evaluating the solvency or the long-term financial health of the company. As you can see, there are different variations, and you could just do a bit of trial and error with respect to the different liabilities and equity or assets, and try and understand that, okay, which sort of liabilities are material and are contributing to whatever ratios that you're calculated, and what sort of in addition to these solvency ratios, we'll also analyze the liabilities and some sort of payment schedule as well, to understand that when the company has to pay back its borrowings, or which might be short term and long term, right? So this basically gives an idea of, I mean, first of all, how efficiently is the company able to manage its capital in few ways as well, although we look at more ratios for that. So I hope you find this helpful. I hope you find this helpful in order to get understand basically this trade-off between debt, which is external capital, and equity, which is internal capital. And we discuss a little bit more about this as well when we discuss the ratios of return on capital and return on equity, to understand this trade-off in a better way possible. But that is pretty much it for now. You have different versions. Pick up whatever you want to calculate, apply that formula consistently, and try to observe the trends in the changes in the different ratios, to see that if there are no serious problems with the financial health of the company. So that is it for this time around. And in the next video, we discuss the next category of ratios.